Hello, and welcome to the Venture Capital Tools website. My name is Dr. Randy Goldsmith. I'm the author of the commercialization tools that you'll be viewing today on this PowerPoint. These tools have been used around the world for more than a decade. In the last 20 years, I've worked with thousands of entrepreneurs, and I can tell you with a great deal of satisfaction that every venture is unique, with unique opportunities. I must confess that with each engagement, I'm hoping to find the ideal deal. Some business plans often purport to be the ideal deal, but it requires validation. Validation means the entrepreneur has verified all the critical assumptions in the business model with outside third-party market experts. This validation applies to all technical, market, and business elements. The quality of the validation process is what separates good deals from great deals. This slide, titled Agony and Ecstasy, reflects the venture development pathway of moving from idea to market to profitability. The horizontal line separating the valley of death and the innovation mountaintop represents the point in time a company is cash flow positive. All companies go through a period of time when they are cash flow negative due to operating costs exceeding revenues. Some companies, like pharmaceutical ventures, can expect much deeper and longer valleys than, for instance, a software company. The objective for any new venture is to make the valley of death as short and shallow as possible. In other words, to become cash flow positive as soon as possible. For those of us who work with new ventures, know that it requires a good plan with support resources to successfully navigate the valley. The venture capital tools are designed to facilitate and accelerate the commercialization process of bringing innovations to market. While these tools are designed to assist ventures seeking investor capital, they apply to any venture regardless of industry, stage of development, or source or type of venture financing being sought. Let's look at three typical type venture models that represent most companies going through the valley. The first model is a self-financed bootstrap company and represents the vast majority of new venture models. This company grows the venture out of reinvested capital, loans, or investments from friends and family. The company goes through periods of positive and negative revenue until such time as it builds sufficient sales and market share to become a viable, self-sustaining enterprise. These entrepreneurs typically retain majority ownership, have a board of directors composed of close business associates, take salary and profit distributions as their primary financial reward, and eventually liquidate the company or leave it to heirs. The second venture model is the entrepreneurial growth company. This venture starts off much like a bootstrap model until such time as some circumstance or event offers an extraordinary market opportunity. This change can occur due to the introduction of a new innovation to the market catching up with a technology that was ahead of its time, a change in market demand, an environmental event, or other factors. This venture model is based upon a sudden need for development capital to exploit the market opportunity. The amount of capital needed is often beyond the entrepreneur's ability to fund, and riskier than asset-based lenders such as debt financing can tolerate. This financing is traditionally provided by third-party private equity investors who provide the capital required in exchange for stock ownership in the company. Application of the venture capital tools will facilitate and accelerate the commercialization process for companies demonstrating this profile. The third model is seen less frequently and is what I call the planned growth model. I usually compare this model with a biotech venture model, one that will require such large amounts of capital that it would be unwise to ever launch the enterprise until sufficient amounts of capital were committed to move the venture well down the commercialization pathway. Application of the venture capital tools are especially essential to successfully launching this type of business model. The commercialization process can be confusing and chaotic for entrepreneurs and companies who've never traveled this pathway before. This toolkit is applicable for new startups as well as existing companies who are developing products or services for market. The challenge for a startup is clearly the most difficult and risky because not only is the company developing a product or service for market, but it's establishing the business model and all the business systems and processes at the same time. The 8 tools listed on the slide apply to any company commercializing a product, and all but the Innovation Readiness tool, which is primarily for existing companies, apply for new startups. Each of these tools is designed to reflect how an investor views the entrepreneur's readiness to assume control of the venture, the commercialization potential of the product, the risk in the business venture, the quality of the business plan, and the value of the venture. This commercialization process is most applicable to venture coaches who are working with entrepreneurs who are seeking financing. It's also reasonable to assume that the tools will be used repeatedly throughout the development of the venture in view of the fact that the quality of the deal will likely improve throughout the life of the venture. While each tool can be used independently of the others, there is a logical sequence that makes the most sense when moving through the commercialization process. Generally, the tools are approached in this order. First, the entrepreneurial readiness assessment, followed by the product readiness assessment, then venture readiness, risk readiness, business plan assessment, venture valuation with a financial assessment, and finally the investor presentation. With weaknesses and deficiencies being identified and addressed with each assessment, the venture opportunity improves from assessment to assessment and from stage to stage. While it is possible for an entrepreneur to apply these tools without the benefit of a venture coach or a mentor, it is strongly advisable to have access to individuals who have experience in venture and product development. This slide reflects the sequencing of the venture capital tools when applied in a coaching model. I think it's important to make 2 points with respect to the coaching process. 1, the venture capital tools provide the coach with a strategically systematic and reliable methodology to assist entrepreneurs in moving through the commercialization process. 2, the value of the coaching model is directly related to the coach's fundamental understanding of the relevance and importance of each point within each of the surveys. The objective of my coaching model is to assist the entrepreneur in developing an achievable business model and preparing a defendable and compelling investor presentation. This model assumes that the entrepreneur engages the commercialization process with an innovation opportunity in mind or in hand. The first phase is the initial assessment, which evaluates the characteristics of the entrepreneur and the commercial potential of the product. The second phase consists of 2 stages. The first stage is a preliminary assessment of the venture's progress, risk, and business model. The second stage consists of verification and validation of the technical, marketing, and financial assumptions. The third phase consists of detailed assessments involving the quality and thoroughness of the business plan, the venture valuation, the financing strategy, and an investor presentation. The number of meetings associated with each stage will vary in time from 1 to 4 hours, depending on progress. The outcome of each meeting should be a critical review of development progress made since the last meeting, and the next list of critical activities to be accomplished in preparation for the next meeting. Generally, it takes between 60 to 180 days to complete the assessments, address the weaknesses and deficiencies, validate the assumptions, derive a fundable valuation, and develop a compelling presentation. Entrepreneurs who complete this process have a much better than average potential for securing funding. Development of the venture capital tools began in 1992 with a national project I was involved in to assist the United States NASA program in transferring technology from federal labs to the private sector. Over a 17-year period of time, I developed additional tools to standardize an approach to technology commercialization and new venture development. You will find all the tools available at venturecapitaltools.com. The site is set up to accommodate a variety of subscribers, including the individual entrepreneur needing access to the tools for as little as a week for $19.99, or a more sophisticated annual portfolio-style subscription at $899 for professionals who want to offer these tools to an unlimited number of clients. There's also a free read-only feature that allows consultants and coaches to set up a free account. Once the coach sets up their own free account, they can assign a username and a password to a client. Once the client logs on using the username and password, the client can choose a subscription that best meets their needs, again, for as small as $19.99. Once the client subscribes and logs on with the username and password provided by the coach, the client will have active access to the surveys, and the coach can review the client's responses with the read-only access. The first tool in terms of sequencing is the Entrepreneurial Readiness Survey. The Entrepreneurial Readiness Level provides a self-assessment tool for individuals interested in evaluating their readiness level as an entrepreneur. This non-scientific tool is designed from an investor's perspective. The scoring is weighted according to which factors investors hold most important in evaluating entrepreneurial traits and characteristics. The scoring is based upon the author's 20 years of experience in working with more than 1,000 early-stage entrepreneurs, participating in several hundred investor presentations, and making direct equity investments. The purpose of the tool is to provide the entrepreneurs with insight into how they might be perceived by an investor. The results of the survey are not a predictor of entrepreneurial success. This slide provides a sample of survey statements in white and the corresponding entrepreneurial responses in yellow. To use the survey, simply respond to each statement that reflects your belief. For example, from a pull-down menu, click on Strongly Agree if you strongly identify with the statement. Answer Disagree or Strongly Disagree if you do not identify with the statement. This slide reflects a sample score to the survey. The survey provides a percentage score in each of the 5 categories and an overall percentage entrepreneurial readiness level score. The overall score reflects your entrepreneurial readiness level. The questions are weighted based upon responses investors believe most important. A score of 90% indicates that you compare with other venture capital funded entrepreneurs operating high-performance enterprises and reflect entrepreneurial characteristics preferred by investors. A score of 80% or higher indicates you demonstrate the skills, know-how, and characteristics of a successful entrepreneur in a self-financed high-performance business. A score of 70% reflects a good foundation for a future entrepreneur, while a score below 70% suggests more work, experience, training, or personal development is indicated to meet the rigorous requirements of entrepreneurship. The purpose of the Innovation Readiness Assessment provides a tool to profile the innovation capacity of existing companies and not particularly useful to a startup company. The tool is based upon Rogers' adoption curve, which describes a company as being an innovator, early adopter, early majority, late majority, or laggard. The survey provides insight into the fundamental factors that characterize innovation traits in a company and provides insight into how a company can increase its capacity for innovation. The survey is a simple multiple-choice answer format. The purpose of the Product Readiness Assessment tool is to provide insight into the commercial potential of the product or service. The Product Readiness Assessment does not take into consideration any of the venture requirements necessary for commercial success, such as financing, management, market conditions, and other business factors. The survey evaluates the product or service opportunity from the perspective of product value and risk value. The product value takes into consideration the intellectual property status, the market objective of the product, how it competes with other products, scope of the solution, and the type of improvement it offers. The risk value takes into consideration things such as time to market, stage of technical and market development, development funds, and regulatory environment. The survey results provide a value to risk index score. Products vary widely in their commercial value with respect to their commercial potential. Investors typically prefer to invest in products over services for a variety of reasons. Disruptive products are those that have the potential to change an industry or an entire economy. Sustaining products are typically improvements to existing products in the form of being faster, better, and cheaper. Investors place greater value on disruptive products. Products offer a value proposition to the user that either increases profits, competitiveness, or enables an increase in productivity. Users typically place their highest value on enabling products. Products can be classified by their degree of change when compared to competing products. This change can be an incremental, advanced, or radical improvement. Investors seldom take an interest in an incremental improvement and prefer to invest in products that demonstrate advanced, if not radical, differentiation. Products are classified with respect to their utility. A product with a single purpose is considered to have a specific application. Products that have a single application across multiple industries, multiple applications within a single industry, or multiple applications across multiple industries is considered a platform technology. A product that meets the requirements to be a disruptive, enabling, advanced, or radical platform product can be exceptionally attractive to an investor. In spite of a product's unique commercial characteristics, successful commercialization is dependent on successfully overcoming all of the venture and market risk associated with bringing a product to market. The next tool is the Product Readiness Assessment. It's a simple multiple-choice survey. All of the survey tools have an information button associated with each question to help clarify the point and explain its value to the survey. The Venture Readiness Survey provides a self-assessment tool to analyze the progress an entrepreneur has made in the commercial or business development process. The Venture Readiness Survey is based upon a commercialization model used nationally and internationally to assist thousands of new startup and existing companies commercializing new products. The Venture Readiness Survey evaluates the technical readiness level, the market readiness level, and the business readiness level of the commercialization process. The venture readiness level will assist an entrepreneur and existing companies in strategizing their commercialization plans. A complete narrative describes the commercialization process, and it accompanies this tool and can be accessed by clicking above in the chart where it says "Click here to download." The purpose of the Venture Readiness Survey identifies the entrepreneur's progress in the commercialization process, assists in developing a go-forward commercialization strategy, identifies appropriate sources of financial capital, and provides sources of business resources. To fully exploit the value of the tool, it's important to understand the logic behind the Venture Readiness Survey. The commercialization process consists of 3 phases: the concept, development, and commercial phase. The concept phase consists of 2 stages: the investigation stage and the feasibility stage. The concept phase is associated with new venture startups and or existing companies considering a new product. The development phase consists of 2 stages: the development stage and the introduction stage. The development stage is associated with new companies that grow from a prototype and no revenue to companies with products and sales. The commercial phase represents companies who are profitable and defending their market position or exploring new product opportunities. Within each stage of development, it is necessary to keep the technical, marketing, and business development activities in balance. To fully exploit the value of the tool, it's important to understand the logic behind the Venture Readiness Survey. The commercialization process consists of 3 phases: the concept, development, and commercial phase. The concept phase consists of 2 stages: the investigation stage and the feasibility stage. The concept phase is associated with new venture startups and/or existing companies considering a new product. The development phase consists of 2 stages: the development stage and the introduction stage. The development stage is associated with new companies that grow from a prototype and no revenue to companies with products and sales. The commercial phase represents companies who are profitable and defending their market position or exploring new product opportunities. Within each stage of development, it is necessary to keep the technical, marketing, and business development activities in balance. Each stage in the commercialization model is broken down into logical and sequential set of steps. While it's possible to address activities within multiple steps at the same time, it's advisable not to deviate substantially from the sequential pathway in order, since the activities of each step support each of the follow-on steps. Each step should be considered a stage gate step, providing valuable information to the potential viability of the opportunity. A go, no-go decision process will ensure that the assumptions and data incorporated into the business model are validated and reliable. Behind each step is a set of questions that address the appropriate activities associated with the step. Additional significant information is available for each step in the downloadable narrative available with the survey. This document is essential for venture coaches and very instructional for entrepreneurs. Do not fail to download, read, and apply this information to your commercialization efforts. It's highly advisable to answer most, if not all, the questions within each step before progressing forward to the next step. The recommended approach to commercialization is to follow the sequential stepwise pattern. This ensures the most efficient use of time and resources and minimizes the number of missteps. It's not uncommon to see entrepreneurs and companies, particularly those that are technically or engineering focused, expend time and resources to develop the technical steps first before addressing the marketing and business steps. This usually results in unnecessary delays when the implications from marketing, research, and business modeling are factored into the commercialization strategy. The scoring strategy used to evaluate the progress of each step helps identify which steps are adequately complete, which steps should take priority, and which activities within those steps are most critical. By assessing the commercialization progress, it is possible to quantify technical, market, and business activities. The overall quantitative progress score can generally identify which source of funding and how much funding is appropriate for the venture at that point in time. While these rules of thumb are very general, they are intended to reflect the reality that different types of investors invest at different times to achieve interim progress towards full commercial success. The venture readiness level provides insight into the financing stage and the technical stage. While many investors do not use a systematic and/or routine analytical structure for making an investment decision, research indicates there are 5 fundamental risk factors involved in their decision: execution, product, market, management, and financial risk. The purpose of the Risk Readiness Survey is to identify how much risk has been removed from the business venture appropriate for its stage of development. In the example above, the execution risk score is 70%. This means 70% of the potential risk associated with executing the business plan has been removed. Most investors would require a total risk score above 70% for a startup venture and a score above 90% for a company with product and sales. It's also important to note that even though the total score is above 70%, any one of the risk scoring components falling below 70%, such as the 50% financial risk score above, it will not likely qualify for funding. Scoring the risk readiness survey is simple. There are 5 risk factor sections with 5 business elements in each section. Each of the business elements have 3 status conditions associated with each of the business elements. To respond, select the condition that best describes your status for the business element. Once there is clear evidence that the product or service has commercial potential, the entrepreneur has the will and the capacity to take the venture forward, there is consensus on venture progress, and a realistic assessment of the venture risk level, it's time to develop a go-to-market commercialization strategy. The purpose of the commercialization strategy is to develop the most efficiently achievable pathway to being cash flow positive. The end product of this step is the business plan. There are dozens of books and templates available to assist in this process, but what most fail to address is risk. A fundamental business plan will be written with a common theme of risk mitigation. Once again, the 5 risk factors play a major part in developing a commercialization strategy, which will be incorporated into a written business plan. This is a team process. It's virtually impossible to write a fundable plan without a team of experts providing input in the form of legal, marketing, financial, engineering, and production information. Ultimately, the plan will be only as good as the level of validation of the information provided. Remember that investors look for reasons not to invest versus why they should invest. Remember, a score of good is not good enough for investors. Remember to have a qualified outsider read and score your plan. Remember to be open to recommendations. Remember, as the business planning readiness results improve, the potential for funding increases. Let's talk about scoring. The assessment provides a menu of responses to each question ranging from poor, fair, good, very good, and excellent. A score is generated for each of the risk areas as well as the overall plan. A score of 90% or higher is excellent, while 80%, 70%, 60%, 50% correspond with very good, good, fair, and poor respectively. Investors would expect scores 80% or higher in all risk categories as well as the overall score. A score below 80% in any single risk category would probably disqualify the plan from investor consideration. Valuation is a term that describes the financial value of the company. To secure investor funding, the entrepreneur will sell stock to the investor. To set a price on the stock requires setting a total value on the business. Setting a price on the business that has little or no assets, no product, and no sales can be a difficult subjective process. The valuation tool provides 5 methods for determining the venture's valuation. 4 of the 5 methods are driven by the financial pro forma found in the business plan. The greater the amount of actual revenue and actual number of years of operation factored into the calculation, the greater the degree of confidence that can be placed in these 4 methods. The 5th method relies on the responses to the risk readiness assessment and is based on the national average of value of startup ventures. In discussing valuation, there are some key terms to understand. Investment represents the amount of capital the entrepreneur needs from investors. Pre-money represents the computed value of the venture before new money is invested. Pre-money investment is usually negotiable between the entrepreneur and the investor. Once a pre-money is determined with the initial investor, that valuation should apply to all other investors in the same round. Post-money represents the sum of the pre-money value plus the total amount of the new investment. Equity ownership represents the percentage of the investor's investment of the post-money valuation. To use the valuation tool requires that the risk readiness level assessment is complete and the information requested is provided. The first information requested is the average price-earnings ratio for the industry sector. The PE can range from 5 to 80 given market conditions. Currently, a PE between 15 and 20 is a reasonable number to use if you're in doubt of the number. As the PE number gets higher, the valuations become less reasonable and less reliable. The PE industry sector average can be found in business newspapers and on financial websites. Next, enter the amount of investment capital being sought. Use the pull-down menu to select the stage of your investment opportunity, recalling that pre-seed is a concept stage opportunity. Seed stage still represents no product and no revenue. A round, or early stage, represents a company with product but still no revenue. B round, or mid-stage, represents a company with product and revenue. C round means the company is growing, and mezzanine means that it's usually for bridge financing, preparing for an acquisition or an IPO. Next, enter 5 years of net income, that is, earnings before income tax, depreciation, and amortization, beginning with the current year of operation. If numbers are not available, it will not be possible to generate a discounted cash flow, earnings multiple, or venture capital method valuation. Once the information is provided, click Calculate Valuation. For pre-seed stage, seed stage, and A rounds, the default and Goldsmith comparable risk methods are probably the most appropriate. The multiple earnings method is most appropriate for service-based companies with a history of revenue, and the discounted cash flow is also appropriate for companies with revenue. These valuations are based upon national venture capital averages for pre-money, average investment, and post-money valuations per round. Valuations will vary by industry sector and geographic locations. Interpretation of valuations should be taken as a general but realistic representation of industry averages. The valuation is ultimately a mutually agreeable value between the company and the investor. Reminder: select the radio button of the valuation method for which you want to generate a cap table. This can be repeated for each of the methods to create multiple cap tables. The capitalization table provides an analysis of the founders' and investors' percentage of ownership, equity dilution, and value of equity in each round of investment. This cash-on-cash analysis provides a method for analyzing the optimal number of rounds and amount of investment the venture model will support based upon current acquisition and initial public offering values. This cap table model is based upon the assumption that investors in each round will expect a 38% equity position. Of course, this will vary in reality with every investment being different. The cap table is designed to 1. Reflect the percentage of equity ownership and cash value of equity with each round of investment. 2. Reflect the increase in equity value associated with a doubling or tripling of venture value between investment rounds. And 3. Identify in which round and at what value the investment is most likely to realize an acquisition or an IPO based upon industry and sector averages. Check the radio button for the appropriate valuation method for which you want to generate a cap table on the valuation page. Click the Save button at the end of the valuation section. Select Cap Table in the dialog box and this will take you to the next screen. The cap table provides a general analysis on the effects of step-up or increases in value on equity ownership percentage and cash values between rounds. In reality, the step-up values will vary between rounds based upon the performance of the venture and market conditions. Increases in venture value between rounds can be much greater than 2 times the previous round. Likewise, the percentage of investor equity at 38% will also vary between rounds. We've now reached our goal, the opportunity to stand in front of an investor and make an exciting, compelling presentation of an investment opportunity based upon solid business assumptions and an achievable business model. It's my hope that the venture capital tools have greatly improved your opportunity to realize your objective. Thanks for watching.